Welcome to Keen on Retirement, a show dedicated to helping you thrive before and during your retirement years. If you are looking to grow and protect your wealth and want to make the second half of your life the best half, then listen in as Wealth Advisor Bill Keen sorts through the key issues that you need to know in a lively and candid way.
Hello, everybody, and welcome back to Keen on Retirement. I'm your co-host, Steve Sandusky, and with me, as always, is Bill Keen and Matt Wilson. Hey, guys.
Hey, Steve, I have to start the episode off this year. It's my favorite time of year in the Midwest. Looking out from our beautiful views here on the 10th floor of the Lighton Tower in Overland Park, Kansas. There's way more green, way more trees than most people realize in our Overland Park, Kansas, in our area. And this time of year, I think my team thinks I'm kind of crazy because I walk around the office and just take pictures out our window of just the fantastic colors, just amazing colors as the trees start to turn. And I just I'll capture that and look back. I showed my wife Carissa last night a picture from my office desk, and I said, "Look at this. This almost looks like it's not even real. They're so vibrant." So, anyway, I love it.
Well, it's nice that you can appreciate that.
That's right. You know, it is nice to stop and smell the roses, as they say in certain forums, and this is one of them. So, I love it.
Exactly. Great. All right. Well, Bill, you, I think, just recently gave a talk or were part of a panel at the University of Central Missouri, giving some comments to the young students there. Any words of wisdom that you imparted to those folks?
Yeah, it was really an honor. That was today. So I just returned back from the University of Central Missouri about an hour ago. It's about an hour drive from the greater Kansas City area in a city called Warrensburg, Missouri. I was a 1991 graduate of that college in finance. And you may recall about a year ago or so, I had the honor of being named one of the 2023's distinguished alumni, it was a surprising call to receive. You might recall I mentioned I thought it was a spam call when they first called me with that offer, but very honored for that for that award, I suppose that they gave. And so after that, I've become a little more involved in the university, and they asked me to participate in a panel speaking to students, mostly students that were seniors, but a few others were there from the Harmon School of Business on just what to be thinking about. I think we had 8 or 9 questions around how to go out into the world and interview and evaluate, what would be a good fit for them to work, and where their passions were, what to do, what not to do, attitudes, outlooks, behaviors, how to take care of themselves. And so I guess you put me on the spot here a little bit. One of the things that I said throughout there was kind of a recurring theme, and what was kind of neat about it was all three of us speakers, we said it in different words, but we said a lot of the same thing. But I said, and it was really cool too, Matt, you'd be happy to hear this, naturally, the Keen Wealth's core values were worked in to what I was talking about, because I shared with the young folks that first off, that remember when you're interviewing with a company, not only are they interviewing you, but you're interviewing them. So show up prepared, do the work to study about the company, study about what they do, who their competitors are, and ask questions. What is your vision? What is your mission? What are your values? Find out, make it a back and forth, and show up in such a way that that company can tell, hey, you know what? This person is excited to work here at our company. They're not just looking for a job. And I think, and that was something that, again, we live this, Matt and I live this every day when we're operating our firm. I said, don't just focus on who will pay you the most money out of the gates. Culture is way more important than who will give you the top dollar right off the bat. Continuous learning, show and demonstrate that you have learned outside of your education there at the university and outside of once you're hired, and even before you're hired, that you've self-taught, that you've gone out and you participated in maybe industry, even webinars, maybe not conferences if you can't afford to go to actual conference, but really show that you've put work in to educate yourself and that you have this always growing and learning mindset, which is one of our values at Keen, always growing and learning. We're all always growing and learning. We've never got it all figured out. And I said, show up with humility, show up with competence, but show up with humility. And working in one of the Keen's values, it's also, we have a value here called humbly competent. We know we're some of the best at what we do, but we're not ever arrogant about it. We're humbly competent. And it's kind of a phrase we made up, and it really, really applies across the board in a lot of areas. So that was, the other thing was be patient. Don't expect to be the CEO or a partner day 2, day 3, year 4. I mean, have patience, and be willing to demonstrate you'll go outside what's expected. You'll do more than you're asked, and work as a team. Finally, I would say one thing I did say that was kind of funny was they laughed at was something that an employer doesn't probably like to hear is, hey, if you're being asked to do something that's maybe outside of your typical day-to-day, you're given an opportunity to step up and show you're willing. Don't say the words, why do I have to do that? That wasn't in my job description. It's usually not well received by an employer. And finally, I was able to, as in my little talk that you just asked me about here, impromptu, thank you, was I shared with the students that I recently got a chance to spend a day, a night, and another day on the USS Harry Truman nuclear aircraft carrier. You all might recall we talked about that, which is an absolute unbelievable experience for a civilian to be able to do that. And the Harry S. Truman values was right in that same line, was the same thing, that highly orchestrated, serious business. It was teamwork is huge. Be willing to go outside your department, be willing to show you'll do whatever it takes so that the mission is accomplished. So that was kind of a quick summary, maybe not so quick, but a summary of the theme to what we talked about today there on the panel.
Well, all good advice. I hope that those students are going to take that to heart and follow through on that, because it certainly has worked out well for you over the years, following those.
Well, we just do our best, we do our best. So, and we're grateful. I can tell you, I'm grateful for the team at Keen Wealth, because our team fits all those bills. They really do. Very grateful. Yes. For the team here.
All right. Well, what we want to talk about today is you also, Matt, I think you just did a recent market updates webinar. We had a few questions that came in from that, so we're going to go through a few of those today. So, Matt, what's the first question on tap here today?
Yeah, we got a question from Daryl, and his question was, when do the algorithms, and I think this isn't in quotations, but I would put it, I think he's joking with that because he knows that I don't have a crystal ball, predict the next correction. What are the defensive moves to take now? And, well, to answer Daryl's question the best I can, based on maybe some sense of a model, there is a metric that the Federal Reserve publishes, and actually the New York Fed puts it on their website, and they have a probability of U.S. recession based on the yield curve. So let's kind of talk about that. And that yield curve is something that I've been covering in my webinars for several years. So the regular viewers of the webinar will hopefully remember this part of it. But the yield curve is just, what are the interest rates that the government pays on short-term investments, such as, we call them bills. They mature less than 1 year, all the way up to, the 10-year government treasury, 20-year government treasury, 30-year government treasury. Well, we're currently in a situation where the yield curve is inverted, which means short-term rates are higher than long-term rates. And that doesn't happen very often, because you think about it, it's like, well, yeah, why would I make more interest investing in something or purchasing a bill that matures in 3 months or 6 months or a year than buying a 5-year treasury? I'm locking my money up for longer. I should earn more interest. There's more uncertainty about the future and what inflation's going to be and everything else. Well, that's true. It's just the Federal Reserve has raised short-term rates enough that short-term bills have increased enough to then say, okay, well, we don't want people to go out and buy these long-term bonds. We want people to buy these short-term ones. They're kind of trying to incent people to do that and increase interest rates across the board. So these yield curve inversions historically have preceded recessions. And right now, the New York Fed's model says 1 year out, there's a 57% chance of recession in September of 2025.
So there's an algo, right? I mean, there's
That's right.
one example of a formula that supposedly predicts that.
Yeah. Back in May of 2024, so this would have been 12 months prior, so May of 2023, it was a 70% chance of recession. In May of 2024, like it was supposed to happen in May of 2024. It didn't happen.
And you never called for it either, by the way, based on other data
I
that you
did
were
not.
seeing. Yeah.
So isn't there an old joke out there, something like, these are the kind of models that have predicted 9 recessions out of the last 5?
Yeah, the economic, the consensus from the economists, they predicted, 12 of the last 3 recessions.
Right.
Yeah. And hey, so when we're talking about some of these things, I'm always thinking and anchoring back to how it affects our listeners who are investors. They have their assets invested in a portfolio of companies and fixed income in instruments. They're living on that money for the rest of their lives. Typically, it needs to last the rest of their lives. And so I'm always thinking, what is this question, or how do we answer this in a way that? So what are we going to do about it? What are we going to do about it? And so when someone asks a recession, what I think they're really asking is the stock market going to go down? That maybe that's not. Because recessions can affect people that are working still. They might be laid off, but recessions affect an investor if the markets, the equity markets, go down. But we know that historically the equity markets go down about 14% from their high each and every year on average.
That's right.
Before it goes back onto its permanent advance. But recall, we've been through 2 bear markets in the last 4 years. We had the COVID, and that was a recession. It was a recession in 2020. It was a government-induced recession. We had a bear market, meaning the broad market was down more than 20% temporarily before it moved on to all-time highs again. And then in 22, this is just 2 years ago, but no one remembers this already. No one even remembers, I don't think. What if we had a bear market in 22? It's just a couple years ago.
The bull market is 2 years old.
Yes. So are we asking, why are we asking about a recession? It's okay to ask, 100% okay to ask, but I'm just wanting to tie it back to, here we are close to all-time highs again, which tends to happen over time, always, as the temporary declines go away and the permanent advance takes hold again. But, it's okay, though. Let's talk about it. It's great. And it's good to know some recessions, obviously, Matt, you talked about, are way deeper than just 2 quarters or 4 quarters or whatever, and they can last longer and be more painful. But I just think it's good to kind of put it in the context of how it affects our investors and what we're trying to do with the pools of capital to last the rest of their life. Make sure we're not making knee-jerk reactions out of fear.
Yep. And this is what it is. The crux of the question is, well, if all of a sudden the markets start to go down, so volatility picks up, well, is there something to do ahead of it? Because we talk about that. The right allocation to have for whenever volatility picks up is before it happens. You can't do it while in the middle of it or change it after the fact. You got to have the right allocation ahead of time.
And the right allocation includes 3 to 5 years of their income needs outside of the equity market and fixed income investments.
What are we pulling out of the portfolio? Well, then that determines we can back into the allocation, and it's going to be different too. For some people, they might say, I still want to be more conservative. Fine, but let's use, real data and examples of, okay, well, if we're pulling this out, we don't want that invested. We want that invested a certain way, very conservative, very liquid, because you're going to spend it. Money past 5 years, 10 years, well, that can be invested differently.
For
You
sure.
can afford to take volatility with that because we know it always comes back. I mean, in the middle of COVID, if you were to ask investors, I mean, you could look at the data, it exists, investor sentiment, it was terrible. People were like, yeah, everything's going to be terrible. And if you would have sold then, you wouldn't have gotten back in, no matter what anyone says, because no one does. And now the market's at all-time highs.
So can we talk about real quick where the Dow was in at the bottom in COVID? I don't have my data in front of me, but it was under 20,000, wasn't it?
We can confirm that.
And while you're looking at that, speaking of COVID and speaking of how that affected the markets, remember the airline stocks. Of course, like few industries got hit harder than the airline stocks during COVID. And even Warren Buffett, who we all respect for his amazing investment success over time, he sold out of one of his airline stocks during that period. Now, I don't know about you guys, but if you've been to an airport lately and you've been on an airplane, it's busier than ever. In fact, in recent months, I think they've been setting record numbers of people traveling through airports these days. And I was just traveling here a week ago, and it's like you can't find a parking spot at the airport. It's all full. So, and I think some of the airline stocks are either at or near record highs, and profits are way up. So, yeah, we need to look at, things may look bleak in the short term. I'm not saying today's short term, but like even during the depths of COVID, things look bleak, but my goodness, things turned around. Even industries like the airlines or the cruise lines, another one.
Hotels,
they got shut down.
all that.
Hotels.
Hotels.
I mean, it all comes back. So the tricky part is just don't get scared out of a long-term investment.
That's right. And to be diversified.
Yes.
We do, you got to recognize that there'll be asset classes that they're in and out of favor based on what's happening. And then going even deeper, it's just certain companies are going to struggle, and they can be great long-term investments, but there are periods where they don't perform very well. When you own enough, you're not just overexposed to one company, one sector, one industry, and you can participate in everything, and you can weather these storms. Because if you're overexposed to one sector or one company, that may not recover. We've talked a lot about that too. I mean, you got companies like Enron that went away. Never going to recover.
That's right.
So, that's the other kind of component to it. But yes, to answer your question, the Dow was 18,000, looked like 18,200.
Yes.
That's
so 18,200. Today we're at
42.
Let's call it 43,000.
Yep.
And so what seemed to be, we were under attack. It felt like our health was in questionable, and we were seeing the assets, the balances go down with the market correction and the uncertainty. And had someone sold out at that point, let's say they had a $2 million portfolio and they sold out, it was down 700,000 or so, and they sold out. The market came screaming back. And it's highly likely that they weren't going to get back in once it's way higher than when they got out. And it's like you said, Matt, a lot of times in the rare cases where usually it's somebody that's done that and they've come to see us after the fact.
Oh yeah.
And they've been sitting in cash for 7 years and,
waiting for it to go back down.
Waiting for it to go back down to get back in. But instead of the next time it goes back down from 43,000 to 37,000, but not ever back to 18,000. And we just see that, and we just want to help people avoid that, but also be able to sleep at night, but have the real data and wisdom and counsel around why we're doing what we're doing, and be able to stay the course to an extent. And then you determine and learn how much somebody should have in equities and how much they should have outside of equities, so that when we go through the next one of those, which we will, that they won't be prone to make what we call the big mistake, and that's bail out at the exact wrong time, like we're describing, because that could be a $700,000 mistake. Imagine that one decision or more, 7-figure mistake. And that's a value of financial advisor. I know we have a lot of advisors that listen to our program, and so I know most of you know that, but if you don't remember those times where you help people avoid those decisions, that one decision could make the relationship with an advisor, the whole entire relationship, that one decision you help someone make or not make, would cover the value of your advice for a lifetime almost.
Mm-hmm. Mm-hmm.
Very true. All right, man. Is there a second question?
Next
Wait,
question
I
we
wanted
have
some
is
more algorithms though, Matt. I mean, is there
Mhm.
something?
Oh, sure. Yeah, well,
Uh,
those are secret. So they have to know the right password for us to give them the secret algorithm. Yes. It's going to tell us exactly what's going to happen.
I actually think I honor the question though, because
Oh,
it's
yes, yes.
definitely human nature to ask the question and to want to know. I mean,
Mm-hmm.
you don't know if you don't ask. So thank
Mm-hmm.
you. Thank you for that question though. I really do honor the thoughtfulness in that.
Mark is asking, I would like to hear if Teen Wealth is using AI in any capacity to help identify slash leverage stock balancing. And yeah, in the portfolio side of things, essentially kind of what it I believe Mark's asking is there a use of AI in on the investment side of the portfolio? And there's AIs being utilized by the companies that we
Mhm.
invest in. We know that for a fact. And actually I look at a lot of research, and one of the research providers reviews conference calls. So every time a company has an earnings release, they have a conference call that goes over the earnings report, typically with the CEO and any of the other C-suite executives, CFO, talk about certain things, and then they can receive questions from analysts. And those conference calls can be useful. You can spend a lot of time listening to them, and they can be actually very boring. So it's nice to have someone summarize and give you the high points. But one of the things that this organization does is look at kind of buzzwords, I would say, and how many companies are saying certain words. And AI, artificial intelligence or machine learning, however you want to call it, if it's doing what people think it's going to do, where it could reduce um, mistakes, errors, it could be create more efficiencies, allow more productivity, it could reduce actually the need for employees, in some capacity, may not be like a huge percentage reduction in employees, but if a company needs one or two less people, I mean, that's just savings that show up in their earnings or allows them to invest in other places. So that's where AI is really going to be the most impactful to investors, is that, well, it allows companies to potentially make more money because it's getting rid of certain things and making them easier to do and more efficient. Now, in our industry, what we do as financial advisors, financial planners, there's some definitely some things that we can use it for in data entry. On the investment side of things, there isn't necessarily any AI tools that we have or that have been implemented across the board in the industry yet, because one, in terms of just making blanket investment decisions in a black box, because, one, that's going to be very risky. And two, the regulators are, scrutinizing those types of things very heavily, because it's like, well, wait a minute, what is this? And how do you know what decisions it's making based on the best interest of what the client needs? So I don't know if that answers his question, but it's kind of how
For
we
sure.
view AI.
Well, I mean,
Here
the
at Teen
efficiencies
Wealth.
that AI will bring even today
Mhm.
now. Now, hey, we'll talk about this more. We'll keep talking about it. Of course we will. Just like we've continued to talk about, Bitcoin or the underlying technology called
That's right.
blockchain that's made things way more efficient and transactions and so forth. I was talking to an attorney, a highly regarded attorney very recently, who said, because I was asking him about AI in his business, okay? And because you hear that AI can look through a 100-page
Yeah.
contract and cull out certain phrases and certain aspects to a contract that
Mhm.
are important. It saves all this time from associate maybe reading through a contract, and he had not embraced that even yet. But he shared with me a situation out of state from where we live, where an attorney got lazy. Wasn't anybody
Mm.
he knew. He's a case that he read about,
Yeah.
where the attorney fed in the case facts and asked AI to prepare a brief, I think it's called, coming back to the court, like a formal brief that was entered in where it cites case law and other things that had happened. And it also puts together the answer to like a lawsuit, if you will, or a motion or a judgment, an injunction. Again, I'm not an expert in legal terms, but that attorney didn't validate or verify that the information that AI put together, although it looked really good, and there was no spelling errors, which was nice, but it ultimately ended up that attorney was sanctioned because AI made up case law that it cited. The cases never existed, but it looked really good.
Yeah.
And so I think, it wasn't good for that attorney when that came to light. But it gives you an idea, like, there's a lot of power here.
Yes.
But at where we sit today, it requires a lot of human interaction.
Yeah. Yeah. Kind of along that, I heard recently of an example. This was during a Monday night football game, and I can't recall who was playing, but essentially AI, people had been Googling something around how many onside kick, because the rules are changing around all the kickoffs, in the NFL. And how many onside kicks can a team have in the fourth quarter? And people online were citing, and this was, I think, a lot on like X, formerly Twitter X, that you can only have 2 onside kicks in the fourth quarter. Well, that's not true. But when you typed it into Google, that was the first result, and that's what everyone was citing was the AI answer, which was wrong because it was, citing probably some blog post that this was what could be proposed, but wasn't the rule. So it's just the information has to be accurate. It's just like garbage in, garbage out. AI is only as good as the inputs.
That's right.
So,
Yeah, and I think something else we're seeing too is this phrase I've been reading about called AI theater.
Oh,
and
yes.
The idea is that a lot of companies on their earnings calls, and you were mentioning this a moment ago, Matt,
Oh, yeah.
people are talking about artificial intelligence on their earnings call because they're trying to get the investors to think that we're really making great strides in our AI initiatives, and it's helping us reduce costs, and it's helping us increase sales, and it's making us more productive. And so some of these analysts now are a little bit skeptical. And so they're starting to label some of that AI theater. And so they have to sort through a little bit of the hype that they're hearing on some of these calls and try and identify, well, what is the actual reality? And I think the reality in many cases is, yes, AI is a substantial game-changing type technology.
For sure.
But we're not seeing, beyond the generative AI applications, which are fun and they help us with creativity and coming up with ideas and stuff. And it can do a lot of analysis, but there's still a lot of work that needs to be done to ensure that the output that we're getting is real and accurate and not hallucinated. But there's definitely some great applications, some great results, but it's definitely going to take time before this becomes super mainstream and we all have high confidence in the output.
That's right.
All right. What else do we have here, Matt? What else is on the minds of the clients?
Last question we've got for today is from Ron, and he's asking about the U.S. national debt and the impact that it would have on our economy, citizens, and the rest of the world.
Well, that's a big question.
Yes, it is. It is. And, we've got the current national debt and the fact that the government's been running a deficit for basically every single year that we can go back 50 years. There's very few years where they don't run a deficit. And so far, it hasn't been an issue. It doesn't impact the stock market. It's really not impacting the treasury market, the bond market. Doesn't mean it won't in the future, but right now, investors across the U.S. and across the world are not concerned that the U.S. will ever have a problem paying back its debt. Now, it can be one of those things that it doesn't matter till it matters. And when that's going to happen, who knows if it ever happens. one of the kind of talking points around this that I was actually put in the webinar from last week was to talk about the two presidential candidates. We've got Harris and Trump and their policies, and they've been evaluated to look at, well, what is the fiscal impact of everything they've talked about on their campaigns on the national debt and, deficit going forward. Harris, they evaluated it, and this was the Committee for a Responsible Federal Budget, a nonpartisan committee. So supposedly, going to be less or more objective, I guess we'll put it that way. And they say the baseline for Harris is $3.5 trillion, and the baseline for Trump is $7.5 trillion. Now, this would assume everything gets passed that they've talked about. No tax on Social Security, no tax on tips, no tax on overtime, home buyer credits, like every single thing, which we all know is basically a 0% chance of every single thing passing. But those would both be very stimulative to the economy. And, so that you look at that and you're like, well, that could be a good thing. Now, on the flip side, does that lead to higher inflation? Potentially. I don't think we're going to see inflation like we saw over the past several years. That was fundamentally a function of COVID and the supply chain issues and the fact that the government was paying people directly. They were giving them direct payments. It's called transfer payments to put in people's bank accounts to go spend. These types of fiscal stimulus where you're reducing taxes, where you're providing benefits to corporations, don't make it in the pockets, the pocketbooks of individuals in the same way. It does kind of in a roundabout way, but it doesn't just give people money to go spend. So it's not inflationary in the same way. So, I don't think that's as much of a fear. It's more just it would add to the national debt. And again, as long as we're able to make the interest payments on that, which so far that's not a huge hurdle, that's not going to be an issue. It does feel like it should be an issue, but it just isn't an issue. And the fact that the economy keeps growing, GDP keeps growing, if we were getting into a situation where GDP was stagnant and not growing anymore, the national debt would definitely be a concern to investors. Because then it's like, well, wait a minute. There's this country that now is not growing and potentially even going backwards, and it's got all this debt. Now that's not good. That's, my view on it. Steve, you've got your modern monetary theory.
Well, hey, before Steve goes there, I want to say I tried to prepare a little bit for this before our show today, and looking at, and again, not to necessarily worry about Trump or Harris, their plans. I guess, which was just, we're talking about it, but is there a GDP growth rate that they assume is better under one of the two that does make a difference? I mean, I hear my question, and I couldn't find it anywhere. What is the GDP growth rate they assume for each of those analysis for each of those candidates? Like, is it higher or not? So like the ratio now of GDP growth to the national debt, those are important to know. And the GDP growth rate. So I'm not seeing, do they use the same growth rate, assuming the policies are, one would engender more growth and one wouldn't, or I don't know. And I haven't seen how they use that, because that's an important piece of that formula.
In the report, they do project the debt as a percentage of GDP in the future.
Okay.
So they have that in there, but they just have probably a baseline scenario for GDP.
GDP is just a stagnant thing. They're not making an analysis that says, hey, if you reduce taxes and you do these things, it's actually going to grow more. They just assume that as a straight line number, and they come up with a output of what the debt would be. Go ahead, Steve. I really love I was looking forward to your take on this, because you've done a lot of research. You've actually talked to some of the top people in this, thought leaders around this subject in your professional work. And you're a professional.
Well, yeah. So let's put modern monetary theory aside for a moment. And I decided to go to another expert to talk about this. I went to ChatGPT. And so I'm going to share some things that ChatGPT said, and I'd like to get your expert opinion on this. So I asked it a question, and basically about people have worried about the national debt for decades, yet it doesn't appear to have led to runaway inflation, high unemployment, or other hugely negative factors. So does the U.S. national debt really matter? If so, how? And is there a threshold level where it will start to significantly negatively impact the economy?
You put all that in there? You asked it all that?
Man.
I did.
Wow. Very cool. I've never asked it that much before. Nice.
So here's what it came back and it said. It basically said it's nuanced.
Yeah.
And so it said, let's break it down. Does the U.S. debt, national debt matter? It says, yes, the national debt does matter, but how it matters depends on various economic conditions, how the debt is managed. Here are key reasons why it does matter. Interest payments, as the debt grows, the interest payments increase, and as a percent of the GDP, it grows. It could, quote, crowd out other areas like infrastructure, defense, or social programs. Also said investor confidence. The U.S. borrows money. We fund the debt by issuing treasury bonds. If other buyers of treasury bonds decide that we don't think this is a safe investment anymore, they may balk at buying them, which could increase interest rates. Policy flexibility. If debt's too high and it's hard to issue new debt, then it might limit the country's ability to respond to recessions or wars because we're over-leveraged. And then it also talked about the long-term sustainability, that a growing debt to GDP ratio signals that the government may be living beyond its means, and that could cause some issues. So let me just stop there. Do you guys feel that what I just said there, does that all sound legitimate and real to you?
Mm-hmm. Yeah, they're definitely all reasonable things.
Yes.
Mm-hmm. Mm-hmm.
And then, I say, well, compared to the other countries on the planet, how do we rank? And but there's all these little corollaries. But I mean, that's a solid group of concerns.
Right.
I mean, no one could probably argue with those.
I'd agree with that. Yeah. And then a second part here is, why has the U.S. avoided runaway inflation or crises, despite these high debts? And here it says several factors help explain why. One is reserve currency status.
Mm-hmm.
So the U.S. dollar is the world's reserve currency, which creates a strong demand for the currency. So even if people don't like our high debts, they're still buying our currency. Second is the low interest rates. We've had low interest rates for quite a while. And so that's kept the borrowing costs manageable. Third is economic growth. The U.S. has continued to grow fast enough to, even though the debt to GDP ratio has been rising, the fact that the economy continues to grow and it's looked pretty good, that people have felt like they still have confidence in our country that we can grow. So you agree, disagree with those points there?
Right. Yep.
My goodness.
Okay.
I mean, I actually do agree with those, which is what we would intuitively say from our experience. It's what we've experienced.
Yeah. And then next part, is there a threshold where the debt becomes problematic? And I think this is really the big question that people want to know.
Sure.
And, I'm old enough to remember back in the 80s, back in the Reagan era, when it was all about these unsustainable budget deficits and we've got to get them under control and so on and so forth. And my goodness, if you look at the actual numbers, what the debt was back then as a percentage of GDP, it was a fraction of what it is today. Yet here we are many decades later, and we've got a good economy. We've got relatively low interest rates or historically moderate interest rates, even though they're higher than they have been over the past few years. We've got relatively low inflation. And we've got good employment numbers, so far it hasn't mattered. So is there a threshold?
Right.
Well, ChatGPT says that theoretically there are tipping points to consider, like, again, the debt to GDP ratio.
Yep.
We know it's gone up significantly, but it, quote, hasn't hit that critical threshold yet. Second is the interest costs. We've talked about that we're paying a lot more in interest, but again, we haven't hit a tipping point yet. And a third, and I think this is really the key one, which is the loss of investor confidence. And so that's the part where we don't know. And, there's that old line from, I don't know if it was F. Scott Fitzgerald or maybe it was Ernest Hemingway, who said, how do you go bankrupt? gradually, then suddenly.
Yep.
And I think that's the same case here, which is when or if will investors lose confidence in the U.S. dollar, in the Treasury, in our country, where they say, I would rather hold the euro or the Chinese yuan or some other currency that I have more confidence in than I do the U.S. dollar.
Yeah.
So I think until or if we ever hit a point where there is a mass move away from confidence in the U.S., that would be where I think the debt becomes unsustainable. So any thoughts on what ChatGPT says there?
Yeah, I mean, you mentioned trade earlier, and trade's denominated in U.S. dollars. So right there is an indication until it kind of watch how much trade is happening in U.S. dollars to give us an idea of when that could be changing.
Right. Yeah, and so I asked it again. I said, realistically, are there any alternatives to the U.S. dollar and U.S. Treasury debt that could knock the U.S. off its Treasury, off its currency reserve status? And it said, here are some of the most viable other currencies that could take place. One would be the euro. I mentioned that. And it talks about the pros and cons of that versus the dollar. Then there's the Chinese yuan, which I mentioned. Then there's gold. Love to get you guys' take on gold too. So obviously gold's been around for thousands of years. And
I know he's going digital here in a second. I know he is, but I'm just going to let it come.
Okay. Number 4 here is SDRs, which are special drawing rights, which is part of the International Monetary Fund. And then number 5 is digital.
Yeah, I knew it was coming.
Bitcoin. Can't have a conversation without Bitcoin there. So those would be some of the key potential alternatives. Now, each of those have their problems and concerns. And again, I think that's one reason why we haven't seen the dollar knocked off its perch, because any alternative to the dollar has its problems.
Yeah, because it's like, well, why is the euro any better than a dollar? Well, it's the same. You're in the same situation, and potentially a lot worse, since the Eurozone is not growing nearly as fast as the U.S. And in China, it has its own issues. And then you start to get into
what
gold.
Are the issues,
it's like,
Matt?
wait a minute, to go back to gold, you'd have to pay off a bunch of the debt. So that's not going to work, or someone's going to just take a big loss.
Yes,
because it's like that. There's not enough of it, and that's a limiting factor to growth by just tying it to some tangible thing. And Bitcoin would be the same thing. Like, Bitcoin to me would make no sense, because it's like, well, if there's a limited supply of something, you're limiting growth. Why do that? And 2, if Bitcoin is just owned by the people who own it, and Satoshi, I guess, supposedly HBO did some big unveil. I guess they know who it is.
They did.
Yeah, I don't know. And
had no impact.
And so this is
dismissed.
Is Bitcoin. There's this unknown man behind the curtain who owns 1 million of them still, and I was like, okay, we're going to base everything on that.
Yeah. Now, Trump did say, he was at the Bitcoin conference some time ago, and he did say at the conference that if he's elected, he is going to hold on to the existing Bitcoin that the government owns. And the government actually owns Bitcoin because they confiscated it from illicit activities. But what they've been doing up to this point is they gradually sell off the Bitcoin, to help pay down the debt. But Trump says, I'm going to actually hold on to it. So now it becomes a strategic reserve.
Yeah.
Maybe that's how we'll
all the Bitcoiners like to hear that.
Yeah, I think we just figured out how we're going to pay off our debt. It's going to put the Bitcoin, regardless of who gets elected.
That's right.
Well, Matt, hey, real quick. I mean, you mentioned China, and we did an episode where we talked about, I think we talked about 8 to 10 points of why the U.S. is the reserve currency and likely will be for a long time. And part of it is you have to have an economy with rules and regulations that you trust. And that's one of the huge issues, I believe, with the yuan.
And here, what ChatGPT said about that is with the yuan, there's all these capital controls in China.
Right.
So it's hard to get the money out of there. So it's definitely not an easily tradable world currency. So there's some issues there. And then, of course, you got the geopolitical issues. It seems like we've got sort of a new world order shaping up here, where you've got the U.S. and some other Western countries, and then you've got China and you've got Russia and maybe to some extent you've got India or Iran,
North
that are
Korea.
sort of aligned, North Korea. Yeah. And so it would be hard to use the yuan when you've got, friends like that.
That's right.
Right. Well, Steve, you didn't talk about modern monetary theory, and maybe that's okay today because,
Yeah, we'll save that for a future.
That's
yes,
right.
you know what I love about it is we just talked about how we use AI in our firm here, and my goodness gracious, we just used it for the episode, didn't we?
Yeah. And
We did.
Its last answer, we proved all of them terrible answers. So we can thank Chat GPT for that. So
Yeah. And I think maybe the key point to make about AI and what I was just saying here when I asked it this question is, it can definitely be used. It has good information, but you still have to have the human in the loop.
that's right.
And that's why I was asking you guys, hey, do you think that makes sense what ChatGPT said? Because it could have just as easily hallucinated and made up stuff. And so that's why we still have to have the human in the loop in many of these situations to use our expertise and experience and interpret what something like AI might say to see if it does make sense or not. So it can help with some good research. It can help with analyzing things, but it still helps to have that human in there who has the wisdom and experience to know when it's hallucinating and when it's making sense.
That's right. That's right.
All right, guys. Well, that might be a good place to wrap up here. Any final thoughts or comments?
I thought it was really a fun episode for me today. I don't know about you two or our listeners. They might say we might get thumbs down on this particular one, but I actually think the questions we received were really, really good questions, and a lot of people are thinking those very same things, and we were able to address some of those issues, and at least our thinking with respect to them. Again, like I said at the outset of the episode, we're in an industry, and we have been. Our mission is to help people make smart and sound decisions with their financial resources. That includes their making smart tax decisions, making smart health insurance decisions, how assets are titled if someone's disabled or ends up passing away untimely or ever when they do. Also, investment decisions, the engine to the plan as well. Figuring out how much can we spend once we retire, when can we retire. What will that look like if we live to 90 or 100, even whatever age that might be? What if one spouse predeceases another? How will we direct our charitable giving, helping folks think through what's important to them, what they value, and how they pass on not only money but values, personal values to the next generation? So I literally could go on with what we do as holistic fiduciary financial advisors for our clients. If you step back and take a 10,000-foot view of just making prudent decisions to ensure our resources serve us and last the rest of our lives as we've planned, do the best we can with our planning over time. And issues and questions like we have today just help people, I think, when we have the discussions, have more confidence in why we do what we do and what we're thinking and how all this kind of works together or is integrated. So, I appreciate the questions, and just reiterate, every single person, in my opinion, should have a financial plan that looks at the facts about their case, that looks at where they stand, that looks at where they want to go. Spouses should be on the same page if they're spouses, and there should be some level of coordination and some excitement about the future. And we call it confidence in the future here at Keen, so that we can live our best lives. So. And all that feeds into some of this detail we talked about today that kind of could seem minutia, if you will, but it's still all important as we continue to always grow and learn. Just like I said, one of the core values of Keen on the outset of the program today.
Very good. All right. Thank you, Bill. Thank you, Matt. And if you'd like more information about this episode, just visit us at keenwealthadvisors.com. You can get the show notes for this and every other episode and all the great blog posts, content that we have out there. Please subscribe to the podcast if you haven't done that already. Please tell all your friends and colleagues about the show as well, because financial education is one of the key values here at Keen Wealth Advisor, and we love sharing this information with everybody. So again, Bill, Matt, thank you. And look forward to the next episode of Keen on Retirement.
Yes, sir. Thanks, Steve. Thanks, Matt.
Mm-hmm.
The Steve Sandusky Advisor Network and Belay Advisor are not affiliated with Keen Wealth Advisors. Opinions expressed by Steve are his own and not necessarily the opinions of Keen Wealth Advisors. Keen Wealth Advisors is an SEC-registered investment advisor. Advisory services are only offered to clients or prospective clients where Keen Wealth Advisors and its representatives are properly licensed or exempt from licensure. The contents of this podcast are intended for the residents of the United States of America. No advice may be rendered by Keen Wealth Advisors unless a client service agreement is in place. This program is intended for informational purposes only and should not be construed as advice on or a recommendation of any particular investment, strategy, or as tax or legal advice for your specific situation. Keen Wealth Advisors is not a tax or legal advisor. To determine which investments may be appropriate for you, consult your licensed professional prior to investing. Information in this program was compiled from sources believed to be reliable. Due to the constant state of data changing, we do not guarantee the timeliness or the accuracy of the information provided. Our views or opinions at the time you are listening to the podcast may be different than they were when the podcast was recorded. Past performance is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any prices that are referenced or market forecasts are as of the date stated and are not necessarily our opinions moving forward. As always, please remember, investing involves risk and possible loss of principal capital. This podcast is not allowed to be copied, distributed, published, or reproduced without permission from Keen Wealth Advisors.